They've finally done it. Washington state has drawn a line in the sand, and it's aimed straight at one of the last financial lifeboats ordinary people have left. Gold, silver, and other tangible stores of value, assets built to outlast inflation, political shifts, and broken promises, are now being pulled into the government's tax net. The very thing designed to shield you from financial manipulation is being reclassified, revalued, and soon, retaxed. This isn't rumor or speculation. It's law, signed, sealed, and set to take effect in 2026. Less than 2 years from now, every ounce you hold could face not one, but 3 layers of taxation: at purchase, at transfer, and at inheritance. The message is clear. The state doesn't want citizens holding independent value. And while the headlines might bury this story under technical jargon, you and I both know what's really happening. They've found a way to reach into the vault of personal independence, not through confiscation, but through quiet erosion. So the question isn't if this will affect you, it's how much. You stand to lose if you wait. Stay with me, because what's coming next will make that picture even clearer. I've been navigating Washington's business and investment landscape for decades, and I've seen firsthand how quickly policies can shift under the radar. I own multiple businesses here, manage real estate, and like many of you, I hold precious metals as a hedge, not speculation, but protection. This isn't theory or abstract advice, it's my reality, and now it's yours too. We often assume that tangible assets like gold and silver are untouchable, insulated from the whims of government. But the rules are changing, and what I'm sharing comes from direct experience. I've analyzed how these new taxes will ripple through local markets, how they affect dealers, and ultimately, how they affect people like us who rely on these assets for security. This isn't about fear, it's about awareness. We don't panic, we prepare. And preparation comes from understanding the full scope of what's coming. If we act with clarity, insight, and timing, we can navigate this shift without losing control over our wealth. This is the conversation we need to have, and the one we can't afford to ignore. The first shockwave hits with the repeal of the 1985 bullion exemption. For decades, gold and silver were treated like financial instruments, like stocks or bonds, insulated from ordinary sales taxes. That protection is gone. Overnight, bullion is now classified as a taxable commodity, and the consequences are immediate and tangible. Imagine walking into a dealer to purchase $10,000 worth of gold, thinking you're acquiring a safe, preserved asset, only to realize $1,000 of that is being handed straight to the state before you even leave the shop. That's 10% of your value evaporating in an instant. It's hard not to feel a surge of frustration. They're not taxing luxuries or optional purchases. They're taxing the very thing that preserves your wealth, the thing meant to protect you from inflation and uncertainty. The math is simple, but the implication is enormous. Each transaction now carries this invisible bite, silently eroding both trust and personal agency. And while this first layer is aggressive, it's only the beginning. Beneath this visible impact lies a second, less obvious tax, one that will affect the way dealers operate and ultimately how much you pay when you try to acquire these same assets. Most people won't see it coming, but understanding it now could mean the difference between preserving your wealth and surrendering it without realizing. The second layer of this tax storm doesn't hit you directly, it strikes the dealers you rely on. The repeal of the B&O exemption means that businesses selling gold, silver, and other precious metals are now taxed at the top line of their revenue. What does that look like in practice? Take a local Bellevue coin shop you visited, or any small dealer who has built a reputation over years. Their margins, already slim, are suddenly pinched. The tax doesn't vanish, it gets passed down. That $10,000 gold purchase we talked about? Now the dealer has to account for extra costs, and guess who ends up covering that? This isn't hypothetical. Dealers across Washington are recalculating prices, adjusting margins, and quietly absorbing the hit where they can, but inevitably, the consumer pays. It's a clever maneuver. Instead of confronting taxpayers directly, the state forces the friction through those who facilitate these transactions. It reshapes the market from the inside out, squeezing both sellers and buyers simultaneously. And it gets even more complex. As some buyers start exploring alternatives outside the state to avoid these costs, local economies feel the ripple. Long-trusted businesses may see a slowdown, community connections are strained, and what was once a straightforward purchase becomes a strategic decision. But this is only the setup. The third tax, the one that can truly erode long-term wealth, is still waiting, and it's far more punishing than the first two. The final layer of this tax trap lands like a hammer. The capital gains tax on bullion. For anyone holding gold or silver as a long-term investment, this isn't a distant concern, it's imminent. Traditionally, assets held for over a year were treated as long-term capital, with a modest 7% tax on gains above $250,000. But the new legislation, formalized under ESSB 5794 as part of a massive $9.4 billion tax package, adds a top tier of 9.9% on gains exceeding $1 million. Pause for a moment and let that sink in. The state isn't just taking a cut at purchase or transfer. It's coming back again, after you've held and hoped to grow your wealth, taxing the growth itself. Even if you're not a millionaire now, consider how quickly precious metals have appreciated in recent years. A lifetime of careful accumulation could easily push you into that top bracket. What feels like prudent planning becomes another avenue for the state to claim a portion of your gains. It's double taxation in action. First when you buy, now again when you sell, and the impact compounds over time. This isn't theory. It's active policy designed to extract more from those who preserve wealth, quietly reshaping incentives and punishing long-term savers. The broader trend is unmistakable. Washington state is systematically widening the net, targeting tangible assets, and ensuring that independent financial security comes at a much higher cost than ever before. For anyone holding precious metals here, ignoring this could be costly, and understanding it is the only way to navigate it effectively. While the taxes we've discussed are alarming, there is a path forward, a way to reclaim control and protect what you've worked for. The first step is timing. If you plan to acquire more gold, silver, or other precious metals, doing so before January 1st, 2026, can shield you from the first wave of sales taxes. Acting now is the simplest, most direct method to preserve value, and it's fully legal. The clock is ticking, and the difference between acting today and waiting could be thousands of dollars on even moderate purchases. Next, consider jurisdiction flexibility. Precious metals are fungible assets, and neighboring states like Oregon and Idaho maintain their bullion exemptions. By exploring out-of-state purchases, you can avoid the extra tax bite entirely. A short drive or slight adjustment in purchasing habits can yield significant savings, and for those holding larger portfolios, this step alone could be transformative. Long-term planning also matters. Capital gains taxes, particularly on assets that appreciate over years, can be mitigated by strategically spacing out sales. High-value holdings can be divided across multiple years or even passed generationally through careful estate planning, maintaining wealth while adhering to the law. Finally, stay informed and adaptive. Laws evolve, and monitoring changes allows you to respond proactively rather than reactively. This isn't about fear, it's about preparation, strategy, and empowerment. By taking these steps, we can protect our assets and navigate a shifting financial landscape together. We don't need to surrender to policy overreach. With foresight and action, we retain choice, control, and the confidence that our wealth can continue to serve us as intended. They may not be coming to seize your gold, but make no mistake, they're taxing it right out of your hands. Every purchase, every gain, every coin you hold is now subject to scrutiny and multiple layers of taxation. And while it's easy to feel powerless, the truth is, we still have options, and knowledge is the most powerful tool at our disposal. They're coming for your gold, yes, but how we respond determines whether we remain in control or let opportunity slip through our fingers. This isn't about politics or partisan debates. It's about financial freedom, about protecting the choices and security that wealth preservation provides. People like us don't panic. We prepare. We analyze, we plan, and we act strategically. Sharing this awareness is part of that preparation. When you talk to others, when you spread this knowledge, you create a community that can navigate these changes together, minimizing losses and maximizing control. So take action. Consider your acquisitions, explore jurisdiction options, plan for capital gains, and discuss strategies with those you trust. Subscribe, share, and comment below. Let's ensure this information reaches everyone who could be affected. Together, we can safeguard our assets, our futures, and our independence. Remember, they may be coming for your gold, but our preparation can outpace their reach. With clarity, foresight, and unity, we preserve not just wealth, but the freedom it represents.